I want to start with you, Ellen. Talk to us about Cliffwater, who they are, what's been their approach, and why we're talking about them, why you guys did a deep dive.
Yeah. So Cliffwater is a sort of pioneer in private credit, really. They started out as a consultant to allocators like pension funds, and then they created their own asset management business, which has grown exponentially over the last 10 or so years. What they do is essentially partner with other direct lenders and take a slice of each of those loans. And that's allowed them to grow very quickly and become hyper diversified compared to other platforms that are just single manager.
It worked out for a while, and it made the founders incredibly wealthy. Olivia, come on in here, because then redemptions started. What can you tell us about why the redemption started and what investors wanted?
Yeah, definitely. So like Ellen's saying, the Cliffwater model is sort of a fund that allows investors to access private credit writ large.
So they're not actually doing loans. They are investing in other funds that are.
They're buying loans from other managers. So it's like a multi-lender model.
Okay.
So when stress started to come to private credit and investors started to want out, Cliffwater was a big place where now anyone worried about private credit that's invested in the fund maybe decided to pull capital. And that's why we saw record redemptions from the fund this quarter.
We have a great chart, and I want to bring it up. It's in the story, and Tim and I were like kind of blown away about some of the graphics that really help tell the story, because we talk about this kind of fund of funds approach, if you will. It's a circular chart, but what it basically is showing, and it's hard for those folks, obviously, if you're listening on radio, you can't see it, but difficult too on TV. But what it's basically showing is that they owned, about a third of Barings Private Credit Corp at the end of 2025, but they also were involved with Ares, right? Blackstone. I mean, walk us through that circle and what it tells us.
Sure. So the way that they've been able to partner with so many managers is by investing directly in the funds, and then they set up agreements to be able to be in the underlying loans as well. So they are invested in, I think, more than 50 direct lenders. They're invested in many. This is one chunk of sort of those types of fund investments. This is the non-traded BDCs and the investment partnerships and specifically, but they have a large holding in Barings, Ares, KKR, you name it, like all the big names. Blackstone.
Kind of a who's who, right?
It really is, yeah.
I think the question that a lot of people have, and we're going to be speaking about this a little later in our program to Olivia, is this question of to what extent are the challenges at Cliffwater or a single firm contained versus are they part of a bigger picture when it comes to private credit and this idea of so-called contagion? What did you find in your reporting?
So I think that we've seen recently that firms are expecting this concern among investors to continue. We saw some lenders that capped redemptions signal that they're going to do the same thing next quarter. So I think we've definitely seen any stress at one fund, managers are expecting it to kind of spill over to their fund as well.
That's what I was curious about. When the stories kind of pitch as one of the biggest question marks in the private credit industry, is it because they are so vulnerable, or that if they start to come undone, then you've got to assume that there is that contagion or systemic impact?
I think people were pointing to Cliffwater in particular because of this fund of private credit funds aspect that's very unique to them. And then also, I mean, they're just really big. It's
How big?
33 billion, which is quite large. I think they're second only to BCRED. So that's pretty large in this market. They're touching a lot of different direct lenders. They're in a lot of loans. Everybody's worried about software and AI disruption. They're in a lot of software. So there's a couple reasons people are focused on.
So is that why, Ellen, it didn't work? It worked until it didn't work. Was it software? What was sort of the straw that broke the camel's back with this?
I think a lot of this comes down to sentiment around software, personally. Yeah. We saw people start to get nervous, and we've reported previously that software is the single largest sector exposure in private credit. It's about 20%, which is sizable. So we're starting to see people get their money out or try to, and we're starting to see gating happen. So a lot of this stems from that.
I will point out, Carol, software companies taking a hit today. The latest example of volatility in the sector, the information reporting that Amazon Web Services is developing AI tools designed to automate functions in sales and biz dev.
Yeah, like we continue to see this on a daily basis, kind of questioning some of the existing models or companies and whether or not, we're going to see more problems going forward. I guess time will tell. Olivia, I want to bring you back in because you've got another story in the Bloomberg that's about Ares Management and Apollo Global capping private credit fund withdrawals as clients want to redeem more. We kind of remind everybody, private credit, not so liquid, folks. You're going to have to park your money for a while, but that's not, so, investors are pushing back. So tell us a little bit more about this.
Right. Yeah. So I think, like we're saying, there's all these fears around private credit, around software, right? But I think a big issue for these lenders is that they went really aggressive into the retail space, and that helped grow their firms a lot. It let them bring in a lot of money, but maybe they weren't prepared for that retail space to sort of turn. And now we're sort of dealing with the first wave of all of these funds having to cap redemptions.
Who's at fault, though? Like when you think about that, and we've had folks on around this table who said, read the fine print. And sometimes that fine print is pretty early in.
Yeah, James Crombie talks about that all the time. Your colleague on the team. He says this is like literally what it says in the prospectuses. So, read the fine print here.
I think that is true, but what is hard is that we've seen some lenders actually decide not to cap redemptions, and they took special measures to return all of investors' capital. So it sort of set this not uniform pace where maybe some investors felt like, wait, I thought I could get all my money back.
Yeah, okay, so what are we watching? Let's go back to Cliffwater. So what do we need to watch? What are you guys watching that is an indication that, all right, this storm, it's not just a short storm, it's something much bigger?
Yeah, I think we're going to continue to watch for redemptions. If they stay elevated, we're going to watch Cliffwater's liquidity levels. We reported that they'll be able to manage this like max redemptions for at least a year without having to sell any assets or sell any fund stakes or anything like that, any extreme measures. So we'll be waiting to see if they can maintain that liquidity, and maybe investors will get more comfortable again and stop redeeming. Maybe they won't.
Right.
Time will tell.